Hi guys! This video will look at the net assets table in a little bit more detail. The net assets table is prepared for the subsidiary, never for the parent. And it's prepared because the parent would like to see how the subsidiary has grown since the date of acquisition. Here is the main format of the net assets list. We show the subsidiary's equity balances and any other adjustments at 2 points in time, at the date of acquisition and at the date of consolidation. The share capital and the share premium balances are going to be the same at both points in time because the subsidiary will not issue any more shares once the parent has gained control. Whereas the retained earnings figure would be slightly different, because the retained earnings figure at acquisition should be different to the retained earnings figure at consolidation, because we expect the subsidiary to make profits, i.e. it grows, or it could shrink, i.e. make losses. There could be further adjustments, for example, the fair value adjustments, which shows the movements between what the market value of the subsidiary's assets are and the net book value of the subsidiary's assets. Wherever the adjustment is, the same figure is put into both columns. The figure could increase the assets or it could decrease the assets, depending on what the scenario is. And as a result of this adjustment, we could have further depreciation implications, which is shown in the consolidations column only because the depreciation charge is for that year only. So for a fair value adjustment going upwards, this could lead to a further greater depreciation expense, so you will reduce your profits. However, if your adjustment will reduce your assets value, then this would reduce your depreciation expense, so you would add it back up. Once again, it depends on the situation. And finally, for the last entry, we have a provision for unrealized profits, which can be denoted as PUP. This occurs when the subsidiary sells to the parent, making a profit. Now, because this is an intragroup transaction, this intragroup balance must be eliminated because we pretend the parent and the subsidiary are one single entity. And it doesn't make sense for you to sell goods to yourself and make a profit when selling. So this profit must be eliminated by the means of a PUP adjustment. Specifically, if the subsidiary is sold to the parent, we must eliminate the profit in the net assets column. Now, once you have calculated the net assets table properly, we then try to look at the totals. But let me just go through this slide here, looking at it in details. In summary, share capital and share premium balances are the same at both dates. Retained earnings are not the same because we expect the subsidiary to have grown or shrunk. Further adjustments would be your fair value adjustment, the depreciation, and the eliminating of profits. Now, once you have, let me just continue what I was saying before. Once you have properly put the figures in the correct place, the parent will then add down both columns, and the totals of each column is very important to help the parent move on to the next step. The sum of the acquisition column is going to be used to calculate the goodwill working, and it represents the market value of the subsidiary's assets on the day the parent bought the subsidiary. Whereas the sum of the consolidations column is equally as important because the difference between the two totals is going to be used to calculate the NCI working and the retained earnings working to be shown on the SFP. And the difference between these two represents the post-acquisition growth of the subsidiary. So these two totals are extremely important to help parents move on to the next step. Now, before we move on to the next step, let's have a go at practicing preparing the subsidiary's net assets table. Let's take a read. BV acquired 75% of JK's 8 million equity shares on the 1st of May 16. So that means the 1st of May 16 was the acquisition date. On that date, the share capital balance stood at 30,000 for the subsidiary. At the year end, the retained earnings of JK in the financial statements was 880,000. and JK made a profit for the year of 144,000. Prepare the net assets table. So for this one is slightly easy. The main items would be share capital, share premium and retained earnings. Share capital, we're told, is 30,000 and it's going to be the same at both points in time. 30,000 at acquisition and 30,000 at consolidation. Whereas for the share premium, I didn't read anything to do with share premium, so we can put a dash there to show no premiums in this question. Now we move on to retained earnings. We're told specifically at the year end, the retained earnings in the financial statements of JK was 880, so we can place that there. But what is the retained earnings of the subsidiary at acquisition? Okay. Now, you bought the subsidiary on the 1st of May 16, so we need to know what the retained earnings were at that date. Your year end is December 16. So that means you bought the subsidiary partway through the year, which means we need to do some pro rata to calculate what the retained earnings were at May 16. So if the whole year's profit was 144,000, and if we take, how many months was it? May, June, July, August, September, October, November, December. If we take away 8 months of the profit away from 880, that will give us the retained earnings at acquisition. So 880 was at December. What was the retained earnings 8 months earlier? So 8 months earlier, you just prorata the profits by taking 8/12 of 144, and that will give you 784. It's best to use a timeline to find out what these figures are. So put 784 in the acquisition column, and therefore their totals are, for acquisition, 814, and consolidation, 910. And there you have it, guys, your net assets table.